And so they're saying, in terms of the accounting, those are all outstanding liabilities of the Fed. The Fed, in effect, owes that person. That's like a receipt of the debt that the Fed has to you as the holder of that note. And the Fed needs to make sure it's got assets to back that up, right? To collateralize that debt, right? So that's the mindset. You kind of see how, if you don't think about it too hard, it kind of makes sense. But what if you do think about it hard? It makes no sense at all, right? Because let's say you've got, again, $1,000 in currency. You got 10 Benjamin Franklins. And you say, oh, the Fed owes me $1,000. And they say this is collateralized. So what does that mean? That means, well, it better be the case. If I show up, you better be able to give me $1,000 to back up this $1,000 I'm holding.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I am going over a framework that economists in the Austrian school for sure, and I think even other non-Austrian economists may implicitly agree with, a framework for the definitions and identification in the real world of money and debt. And that might sound like it's pretty straightforward, and I thought it was too, but as we'll see, things get really complicated when you start bringing in modern banking and then also blockchain technology. And some of these categories get fuzzy. And then when newcomers who are experts in these new developments, like people who study modern commercial banking under what's called sometimes the fractional reserve banking system, or who are experts on how does Bitcoin work, and then they're experts in terms of the actual mechanics of it, like technologically speaking, how does it work? What is the blockchain, the original Bitcoin blockchain and so forth. And then they start generalizing and trying to build a theory of money with Bitcoin as their primary example that they have in mind. And we'll see that I think what happens in practice is they start running into trouble, that they build frameworks around the particular example they have in mind, but it doesn't generalize. And as I will argue, the old school original frameworks are actually more robust and they can handle the newcomers while avoiding certain paradoxes or at least mental somersaults. Okay, so that's a little bit of a sort of abstract explanation or motivation, but I think the easiest way to proceed here is let me go ahead and give several examples of the kind of what I think are fuzzy ways of thinking on money and debt. And then I'll just go ahead and sort of give a general response that knocks them all out. So I had toyed with it first. I was going to do this episode by taking each example I'm going to show you folks in a second in one at a time and then just pulling them apart. But I think that it will be easier if instead we just go through like the whole things all at once. And you can see I've been having people try to call me. I've turned that off now. Okay, so what I'm going to do here first is show you some screenshots that I've just been collecting. It's not like I've been building this thing over the course of 6 months and all of a sudden the dam broke and now I got to address it. This stuff all just came in fairly recently. I was like, oh, maybe I'll do something on this minute. And I realized these are all fit together. And that's what guided my choice in terms of what I'm actually how I'm going to package the episode you're listening to right now. Okay, so the first one is from David Graeber, who was maybe anthropologist. Is that the right term for what he was? But in any event, he wrote this massive tome on debt. I think it was called Debt, the First 5,000 Years. And in it, he takes aim at the standard economist approach to explaining the origin of money. Right. And so here's this quote that was going around social media. So this is Graeber. In fact, our standard account of monetary history is precisely backwards. We did not begin with barter, discover money, and then eventually develop credit systems. It happened precisely the other way around. Okay, so just a little bit of explanation here so you're not completely lost. The standard economist account is originally people are using barter that was inefficient for various reasons. Then, quote, spontaneously, people started using media of exchange, the singular being a medium of exchange. And then one of those commodities outstripped all the others, and then that emerged as the money for that community. Okay, and I'll tell in a minute here when I go and give my own framework, I'll go over that story a little bit more concretely. All right. And then once you're using money and you understand what money is, then you can start making loans in terms of that money. And then credit systems can build up around that. And people can buy and sell assets that are like packages of promises to pay people that underlying money commodity. And that's what we mean by credit, right? So in the standard framework, first there's barter, then there's money, and then there's credit systems. And Graeber's saying, no, it's the other way around. And what he means is, if you go look out in the historical records or look at archaeological digs and things like that, you don't find any evidence barter economies. You don't ever, explorers never stumbled upon some isolated tribe somewhere and they were observing the people from afar and realized, oh, they're just engaged in pure barter. They don't have money. They don't know what money is. He said, you never find that. He says, and what you do see is historically people would engage in intertemporal, meaning like through time transactions where like, oh, this guy, he has a good kill. He brings down some big beast and he can't eat. He and his family aren't going to be able to eat all that thing before it goes bad. So they share it with their neighbors. But then it's sort of understood, okay, next hunt, if your neighbor now gets the big kill, then you're going to share with us, right? Or somebody needs something, they need help fixing their dwelling, the neighbors chip in, but then down the road, oh, if you have a big harvest and you can't get it all yourself, then we'll help you. So these are like over time reciprocal debts that people owe each other, favors, if you will. And then Graeber thinks that's what you see first. And then that somehow becomes systematized into money, right? Like the generalization of those debts that people have to each other over time. And then somehow barter emerges out of that when there's a calamity and the monetary system breaks down. And then people revert's not the right word. The first time it happened, it was they develop barter out of necessity. Okay. And that's what he means by saying in actuality, it's the other way around. It doesn't go barter, money, credit. It goes credit, money, barter in terms of the chronological development. Okay. So I disagree fundamentally with that. I think that's totally wrong. And I've looked at his book and I think he misreads the historical evidence that he thinks he's just being empirical and evidence-based where it's these ideological economists who just have their pet theory. I think he's wrong, but I'll defer further commentary. Let me just get through these so you can see where I'm coming from. The next one I want to mention is it's a quote from Perry Merling. And by the way, the reason I like a lot of these examples, and I hope this episode doesn't come off as like I'm grinding some ideological axe, that some of these people have the whole spectrum. Like I think Graeber was I think for sure he was a socialist. He might have even called himself a communist. I don't remember. Where some of these other people are just middle of the road, kind of conventional political views, and then others are extremely friendly to the free market. Okay. And yet I'm thinking they all are wrong about money and debt in a similar way. And that's why I'm putting them all together here in this sort of lumped critique. Okay, so Perry Merling says, money is nothing more than a form of debt, which is to say a commitment to pay money at some time in the future. The whole system is therefore fundamentally circular and self-referential. There is nothing underneath, as it were, holding it up. Okay, and so I haven't seen in the full context of what he's saying, like that particular quote, but I'm virtually certain that what he's getting at here is that in our modern economy, for example, commercial banks, there's a sense in which they create money by granting a loan. And so if you say, like, oh, yeah, I like someone says, how much money do you have? And you say, oh, well, I got a $20 bill here, but I also have $1,000 on deposit with Bank of America in my checking account. So that's $1,000 that I have. That's money that I own. And somebody says, oh, well, what is it? Is it like a bunch of coconuts? I say, no, if you press the person and say, what do you mean that you have $1,000 at Bank of America? Ultimately, what you would mean is Bank of America owes me $1,000. That's really what it means for me to say in our modern language, I have $1,000. Okay, and so that's what Merling is saying here, that money is nothing more than a form of debt, which is to say a commitment to pay money at some time in the future, right? So if you say, oh, okay, by you saying you have $1,000, really what you mean is Bank of America is going to pay you $1,000 whenever you demand it, right? They owe it to you. Okay. So you see how there's something kind of weird right there? Well, wait a minute. What does it mean to say you have $1,000? It's that Bank of America owes me $1,000. So how could Bank of America ever come good on that? And one thing you could say, so I don't hear if Perry gets into this. He probably does, but again, I'm just reacting to this quote that I saw floating around on social media, is you could say, oh, well, they could give you Federal Reserve notes. But if you press that and say, well, what's that? Well, even in the title, a Federal Reserve note. So it's on the Fed's books, so that's a liability, like in terms of the way the Federal Reserve does its accounting. And so there's a sense in which, even if you got into that layer of subtlety and you move beyond just commercial bank credit and pushed it back a step, you're still dealing with what is like a debt, right? That if you have a $100 bill that's a Federal Reserve note, there's a sense in which, oh yeah, that's like the Federal Reserve owes you $100. That's what that means. It's like, instead of Bank of America owing you $1,000, now you've got 10 of these pieces of paper that say the Federal Reserve owes you $1,000 in a sense. You say, okay, but what is $1,000? You could hold up those pieces of paper. That's this. You say, well, what are those? You say, oh, the Fed owes me $1,000. That's what it is, right? Now let me push it in case you just think I'm like, but anyway, let me just reread that Merlin quote for the benefit of the people who are listening to the audio version of this. Money is nothing more than a form of debt, which is to say a commitment to pay money at some time in the future. The whole system is therefore fundamentally circular and self-referential. There's nothing underneath, as it were, holding it up. Okay, so since I just elaborated there on this example of some guy thinks he has $1,000 and when you keep pushing him like, well, what does that mean? I hope that makes Merlin's quote intelligible to you, and you might not only say, oh, now I get what he's saying, you might think, wow, that's really profound. What the heck? That's weird. Okay, let me now read to you from a Federal Reserve audit. So this was the auditor's report on the combined financial statements for the Federal Reserve banks. It happens to be for the years ended December 31st, 2017 and 2016. Okay, but this is just because somebody sent me a blog post that linked to this. I'm sure this pattern, if I were to have dug up the most recent report, I'm sure it would be a similar thing. But anyway, you go and look through this thing and look at what the auditors of the Fed's financial statements say about the Fed's assets and liabilities. You go to this subsection J talking about Federal Reserve notes. Again, open up your wallet or your purse if you're an American and you have, quote, US dollars on your possession, the cash, currency, and go look at them. Printed on them, they will be referred to as Federal Reserve notes. So if you want to know, what do the auditors think about these things? What are they? Let me read you this. Okay. Federal Reserve notes are the circulating currency of the United States. These notes, which are identified as issued to a specific reserve bank, must be fully collateralized. All of the Federal Reserve Bank's assets are eligible to be pledged as collateral. The collateral value is equal to the book value of the collateral tendered, with the exception of securities, for which the collateral value is equal to the par value of the securities tendered. The par value of reverse repurchase agreements is deducted, blah, 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 blah. All right, it gets to the specifics. Okay, but again, let me just reread that. Federal Reserve notes are the circulating currency of the United States. These notes, which are identified as issued to a specific reserve bank, must be fully collateralized. All right, and I want to say this goes along with what Perry Merling was saying. And if you think about it for more than 2 minutes, like your head blows up or implodes, either way, right? Because let's shift context for a minute. What would it mean in general when you got to pledge collateral, right? Like you want to borrow $20,000 for something and you pledge as collateral your house, right? You want to go buy something and you want $20,000 and you want to borrow from the bank and they say, well, sure, we're thinking about lending you this $20,000, but do you have any collaterals? Yeah, I'll put my house up and there's no lien against it. I own it free and clear. I'm pledging the house as collateral. So what does that mean? It's saying in the event that when you are supposed to start repaying that loan, if you fall behind or just outright default on the payments, then the bank has the authority to seize your collateral, to take your house, sell it, get money, pay itself back, and then give you whatever's left. And so if the loan is to be fully collateralized, it means that whatever assets you have backstopping it, sort of guaranteeing the loan and your ability to repay, have to at least have a market value of what your outstanding debt is, quoted in money, right? Meaning if push came to shove, you would be able to turn your asset into enough dollars to be able to pay the creditor back, okay? That's what it means to collateralize a debt in other contexts, okay? So here now, when they're saying, oh, the Federal Reserve, their notes are liabilities of the Fed, right? So if the Fed wants to go buy $20 billion of mortgage-backed securities or treasury securities, electronically, they just create the $20 billion, effectively, quote, write a check to the sellers of those bonds. Those people put it in their bank account. There's clearinghouse operations, blah, blah, blah. Then when the dust settles, whatever, Bank of America or Citibank or whatever, their reserve account with the Fed goes up by $20 billion. And now the Fed on its asset side has $20 billion, at least in book value, of mortgage-backed securities or treasuries. Okay, and so from the Fed's point of view, its assets and liabilities both just went up by $20 billion with that transaction. Okay, so the Fed's reserves are liabilities of the Fed. And the way our system works, if Bank of America says, hey, a lot of customers have been hitting our ATMs, we're running low on physical green pieces of paper, we want another $5 billion in actual currency. Hey, right now, that $20 billion that we just got added to our reserve balance with you, subtract 5 from that, print up $5 billion in new currency and send that to us. Okay, it's the way our system works. Federal Reserve notes are equivalent to electronic reserve balances that the main banks have with the Fed. Okay, and then what that auditor's report was saying is, at any given time, there's a bunch of outstanding Federal Reserve notes. People are walking around with $1 and $5 and $20 and $100 bills in their wallets or purses. People have them in their home safes. Drug dealers in Latin America might use US dollars, like the green pieces of paper, to evade detection. Okay. And so they're saying, in terms of the accounting, those are all outstanding liabilities of the Fed. The Fed, in effect, owes that person. That's like a receipt of the debt that the Fed has to you as the holder of that note. And the Fed needs to make sure it's got assets to back that up, right? To collateralize that debt, right? So that's the mindset. You kind of see how, if you don't think about it too hard, it kind of makes sense. But what if you do think about it hard? It makes no sense at all, right? Because let's say you've got, again, $1,000 in currency. You got 10 Benjamin Franklins. And you say, the Fed owes me $1,000. And they say this is collateralized. So what does that mean? That means, well, it better be the case. If I show up, you better be able to give me $1,000 to back up this $1,000 I'm holding. And so what would the Fed have to do to say they're fully collateralized? It means, we have enough assets pointing to those particular $1,000 that you're holding that we could sell these assets off and get at least $1,000 in Federal Reserve notes to be able to give you that in case you wanted to redeem your $1,000 in Federal Reserve notes. And that we have enough assets that we could exchange because, that's what it means. So do you see how you're just arguing in a big circle? Okay. Anyway, I'll stop that. Like if it's not jumping out at you why that's weird and it doesn't work in that example the way it works in any other example where the thing being collateralized is not a promise, is not itself the thing that's being promised. That's what I'm trying to say. So this kind of, you see what I'm saying? That's almost like an outshoot or offshoot, I should say, of what Perry Marilling put his finger on. Why there's something weird going on here? Okay. That talking about collateralizing the Fed's obligations, what it did make sense on the gold standard era, right? During that period, that regime, where the Fed stood prepared that if you turned in money, cash, US dollars, they had to give you gold. And then it would make sense to say, for all the outstanding Federal Reserve liabilities, they have enough, or they stand ready to give you gold. And maybe they don't have just all gold. They could have other assets too. But in principle, they should be able to sell those assets off to raise the funds with which they could buy gold, or they could just directly sell the assets for gold to be able to get square with everybody. Because it's not that what they ultimately owed you was literally the same thing as their own liability. To make sense, the liability should be denominated in something other than the liability itself. So when the dollar, let me put it in these terms, originally the US dollar, it wasn't merely that it was pegged to gold or silver. It was defined as certain amount of grains of gold or silver. If you go back historically and look at like the actual original coinage act and stuff like that, try it this way. The US federal government after the Constitution did not print US notes that were legal tender currency until the Civil War, when so-called greenbackers were issued. So there was paper money that people would have referred to as dollars, but those were issued by commercial banks. They were banknotes, and they were like claim tickets that said, if you want, you can present this to a bank and then we will hand over to you the proper amount of gold and silver coins that are stamped like a $10 gold eagle coin that has a certain amount of gold in it as defined by the statutes, or a $1 silver coin. This $1 US that has a certain, the required amount of actual silver in it, because that's what the dollar was back then. Okay, so you can see that was the original bedrock foundation of all this. And then over time, once they stripped the dollar of its metallic content, they kept the remnant of, or the superstructure in terms of the accounting and whatnot. But now it doesn't really make sense. All right, all this stuff about collateralizing and outstanding paper notes that are Federal Reserve notes are liabilities of the Fed, and they better have the assets to back. That all makes sense when the dollar itself is defined as a tangible commodity. It doesn't make sense if the dollar, well, let me put it this way too. I'm not merely making an argument about fiat versus commodity money. It's more than that, right? So if the dollar were simply just, oh yes, green pieces of paper and the federal government can print them at will, that also would solve the logical paradox. Economically, there would still be some issues involved, but logically speaking, that would make sense. There'd be no contradiction, okay? But I'm saying we're in this weird thing where, because the practices of the Fed and so forth still are the vestigial remnants of that older system, that's why you have these apparent paradoxes. Okay, let me now just play 2 video clips to go along with this as well. So here is Jeff Snyder. So again, now we're flipping over. Jeff Snyder, I've had interviewed him on other podcasts, and he ideologically is aligned, with my views in many ways. He's certainly not a liberal progressive interventionist who hates capitalism or something. His big claim to fame, though, is he's the founder of what's called Eurodollar University, and he thinks that the way textbook economics and also most commentators on CNBC, or the way that they talk about money and banking, is obsolete. And, especially if you've studied what's called the euro market, he thinks that's crystal clear. But here, let me just play this clip from a recent video that somebody sent me.
When did the dollar stop being the dollar? Now, some people might answer August 15th, 1971, the date when President Nixon finally ended convertibility into gold. But the reason he did that was because the country, and indeed the entire world, had long before then stopped using dollars. They had turned to a very different sort of dollar that had basically taken over by the end of the 19th century. So while there isn't a single date, year, or even decade for this transformation, there is a clear line of progression that we can follow, an evolutionary path, which of course intersects with all the world's major events, since money is intricately linked to all of them. The dollar we all use is a ledger dollar, not government money, and sure as hell not Federal Reserve money. It's a form of bank money because banks are the bookkeepers. They are who society has chosen to keep track of all of its commercial and financial transactions. That's what banks really do. They take their own individual ledgers and integrate what's on them with other banks, thereby creating networks which allow virtual transfers and transactions to take place these days basically anywhere in the world. Just saying that, you should understand why the free market chose this kind of money. Our modern society utterly requires the kind of mobility and flexibility only ledger money could possibly provide. If you actually think about this and go through history, the dollar that everyone thinks of never really had its day. The bank dollar did, and then the euro dollar certainly, but fiat currency was never much of a thing because the free market had vastly different priorities. Now, physical dollars still exist and can obviously be exchanged, and even banks will accept them. It's just that the vast majority of the world wants nothing to do with that form of money. Therefore, we use an entirely different format, and one that is responsible for a whole lot more than maybe you realize.
Okay, and then, so Snyder, what he's talking about there has to do with Bitcoin. That's where he, I think, is intersecting with all this stuff. And this idea of money as a ledger and ledger-based money, that was something that is used by Lynn Alden in her book, Broken Money. So on this very podcast, I interviewed her about that. broken money, right? And so Lynn is a huge proponent of Bitcoin, right? So if you understand how Bitcoin works, it's a public ledger. They call it a distributed ledger. Nobody's in charge of it. It's not that you got to ask Bank of America, hey, how much do I have on deposit with you? This is all, to know how many Satoshis you quote control. This is all available on the ledgers that everybody can download, and there's thousands of copies floating around planet Earth on various systems, right? So that's what Bitcoin is. And so you can see how if you're thinking of it in that form, and then now also going along with the idea of, in modern banking, there's a sense in which when I say I have $1,000 in my account at Bank of America, what does that really mean? It means Bank of America owes me $1,000. That's what it means, right? And so if you start, do you see what I'm saying? That these are all getting lumped together. And again, Lynn and Jeff are fans of the free market. I'm not saying they're as crazy about it as I am, but they're big fans, as opposed to some of these other people I'm talking about are not. But you notice the similarity here in their perspective, right? They all think that there's something about credit-based money, and there's a certain circularity to it. Okay. And then the last clip I'll play here, Richard Berner was recently on Tucker Carlson's show. He talked about a lot of stuff. Some things I agree with him strongly on, other things don't agree with him all about. But this issue of banking also was very relevant. And again, Berner is somebody who thinks, in the modern world at least, the way the system has worked for a few centuries, that commercial banks create most of the money, and that's where the power is. And if you want to understand money flows and things like that, you got to look at private credit creation, where banks, in the mere act of granting loans, create money ex nihilo. It's not that banks function as intermediaries and there's lenders, there's like households that are responsible and they save, they live below their means, they free up credit, channel it through the banks who then lend it out to borrowers, and that the banks just act as passive intermediaries. No. When they're saying banks create money in the act of granting loans. So let me just play a clip pertinent to that.
But ask an economist, an academic research economist, and they will not mention banks.
Well, ask any person, who do you owe money to? The bank. Some version of a bank.
Exactly.
Yes.
Well, the reason is that the economists follow this theory that banks are just financial intermediaries. They just gather deposits here, do their analysis, credit analysis, risk assessment and all that. And then they allocate the funds and invest. Okay?
Right. They just take a percentage. They're a pass-through.
So they're intermediaries.
Yes.
But that's wrong. That's not what they are. It's one theory of banking, and it's still the one that's still dominant. All the textbooks and the leading journals, they still use that. But actually, if you look into it, you realize there's three theories of banking. The second theory, slightly older, that was dominant until the 1960s, so-called fractional reserve theory. And you may have heard this fractional reserve banking. What is that? Well, this theory says, and this part is similar, each bank is a financial intermediary. It just collects deposits and then does the analysis, lends out the money. But in aggregate, as banks interact, there's money creation. Oh, and that's where students' ears should have pricked up, money creation. They even talk about a money multiplier. What? That's the second theory. Now there's a third theory, and that one had been made out to be a wacky conspiracy theory.
Oh.
But it is the one that was more or less quite widely known until about a century ago.
Mm.
And that's the credit creation theory of banking. And this one says banks are not financial intermediaries. Banks are special. They have a unique power that no other player in the economy has. And that is the power to create money.
Okay. So I hope you've seen the common thread through all of these, either still shots or videos that I've played for you folks, is that what these people have in mind is that money either never was or at least no longer is an actual self-contained thing, that it is embedded in a relational network, and that it exists as, what something being money really is just a condition of somebody is owed something, whether, that debt or that liability is recorded privately by some commercial banker on a piece of paper where the public has to trust that banker's reports about what the ledger says, or whether it's a distributed public ledger that no one individual can influence, and there's proof of work and blah, blah, blah in order to update it and add a new block to the chain. Either way, though, that's ledger-based money. And notice, too, how that flows into what Perry Merling said, and even is related, though not as obviously, to the stuff that Graeber was talking about, that money is really just a debt. Okay, so let me, now that I've laid all that groundwork, just sort of pause and give what I think is a better explanation of what money is, what a debt denominated in money is, and then some commentary on the historical evolution of these various systems that I think avoids some of those paradoxes and it is a more accurate representation. And then also, just in terms of being robust, if your definition of money, for example, is being basically a ledger, well, that can't possibly be the definition, because that clearly doesn't apply to commodity-based money, right? Historically, there were all sorts of things, commodities that were used as money, not just gold and silver coins or gold and silver like the actual metal, not whether or not they're stamped into coins, but cattle, seashells. The yak famously have these giant stone discs that they would erect, and that was like, oh yeah, that's my family's wealth right there represented, and you could pledge it and so forth in commerce, even though you couldn't walk around town with it, it's too heavy. So there's no sense in which those things are ledgers. And I think I even asked Lynn, I know I asked her at some point, I think I did it here on the InFi podcast, and saying, what about those earlier ones? And I think she said something like, well, it's kind of like, you imagine like it's like a ledger with nature. Like originally all of the gold was buried in the ground, and then through work, proof of work, it gets transferred into the possession of various people. And you can kind of just still think of it, well, yeah, you can do that. But then I could say dating is just a ledger, or the way stars work is just really a ledger if you think about it. And I could just take the existing theory and just put it, take it and just slap it on ledger terminology that doesn't really mean anything and isn't real, right? Because the way in which you can say Bitcoin is fundamentally tied to a ledger is far different from saying gold as money was tied to a ledger, because no, it wasn't. All right. So now let me just jump into the historical and theoretical framework that I got from Ludwig von Mises, and I hope that will give what I think is a more robust way of thinking about these issues. Okay, so let me quickly go over my perspective on this stuff. And here I'm drawing heavily on the Austrian school in particular. The entire framework for money and banking is first laid out by Karl Menger, and then Ludwig von Mises, and finally Murray Rothbard. And I'll link in the show notes here to my book, Understanding Money Mechanics, put out by the Mises Institute. That lays out all this stuff more systematically. And a lot of these themes I've been hitting on here at the InFi podcast over the years. So you folks who are longtime listeners should recognize some of this stuff. But again, the point here is not to defend my turf and score ideological points or so forth, but just to show, I think there's a reason that the monetary economists who developed this framework and have these standard definitions and so on, that their framework is pretty robust. And that's why the way economists have been thinking about money for a long time, at least the good economists, in my opinion, that's still a very viable framework. And some of these more newfangled upstarts coming along and proposing something new, it doesn't quite fit in. All right. So without further caveats here, let me just dive right in. So the standard account for the origin of money, Karl Menger, who's the founder of the Austrian school, actually wrote the entry for this in a social science encyclopedia back in the day. So Menger's famous work that was considered the founding of what is now called Austrian economics. They didn't call it that at the time. He happened to be from Austria. The Grundsatz, Principles of Economics, in 1871. Okay, so what Menger said was that there's problems to explain the origin of money in terms of just assuming it was like some wise tribal chieftain or a group of elders, that, a state theory of the origin of money or just some sort of authoritative issuance of it. That doesn't really work, because money is kind of weird. Something qua money, it's like people give up valuable items or services in exchange for this thing that intrinsically might not be very valuable, especially if you're thinking about stuff like seashells and stuff that historically have served as money, right? And so why would they do that? And it'd be hard to imagine a wise king or something saying, hey, how about everybody, when you want to get rid of something, here, give me this shell that I just picked up off the beach. You're going to trade it in exchange for these things. You might say, why would I want to give up my valuable horses for that seashell or a bunch of them when I don't need to use seashells? And the answer is, he might continue, because everybody else is going to do the same thing. So if really what you want to do is trade your horses for eggs, then just go ahead and trade your horses for seashells, and then the person who's trading eggs will give them up in exchange for seashells, and that's how you'll complete your transaction. Right? If you said it like that, that would sound nuts. So well, why don't I just trade the horses for the seashells, the eggs directly instead of going through that's crazy, right? And so that's part of it. Also, Menger said there's no historical record, right? You would think if some person just had this great idea and invented money, we might have a record of that or something, and we don't. Right? So instead, he offered an explanation where money emerged spontaneously, not because some individual foresaw its advantages and realized, oh, why don't we use it? But just as you'll see, step by step, each person acting in his or her own narrow self-interest spawned the adoption of money, even though nobody really understood the full implications. So the real quick version of the story is that we start out in a state of what you could call barter. And that makes, there's gains from trade. People are walking around. Somebody's got a bunch of horses. Someone's got a bunch of eggs. The person who has 10 horses might not value that 10th horse very much, might value the first 100 eggs, well, maybe 1,000 eggs more, and vice versa. The person who's sitting around with 10,000 eggs might value the first horse more than the 9th through 10,000 eggs. And so they might have a mutually advantageous trade. Okay, you gave up one horse for 1,000 eggs. Okay, it could be flow over time if you're wondering how you walk around 10,000 eggs. Okay, so that makes sense. So there's voluntary trades give win-win and exchange possibilities, but there's limitations to direct barter, right? That if you're somebody who, you make a fancy telescope and you'd like to get a bunch of, collection of goods in exchange for it, you're not going to find somebody who has that exact collection of berries and eggs and cattle and blah, blah, blah in exchange for this really fancy telescope that you spent months or years building. That's not going to work. Okay. And so Menger said what happens in practice is that if you have a commodity you're trying to unload, even if you don't find someone who's the exact counterpart of you, so long as you find someone who wants your commodity and has something that's more saleable, is the direct translation of the term he used, because he wrote it in German, then you'd be willing to give up your commodity for that thing, right? Because that puts you in a better position. You're closer to your goal. You're more likely to find somebody who has the thing you want and wants the new thing you have in exchange for the original thing you gave up. Okay, so Menger just walks through this analysis and explains how step by step you can see how people would rank things in terms of their saleability, or nowadays we might say liquidity, or the size of the market that this thing has. And other things equal, even if you can't directly find the thing you ultimately want, you'd give up what you have in exchange for something that's more marketable or liquid than what you started out with. So now if everybody's doing that, what happens is things that initially started out with an advantage in terms of marketability or liquidity, where, a large chunk of the community already wanted this thing, now that advantage gets amplified. Because now even people who didn't originally want that thing might be willing to accept it in trade, knowing, oh, there's a lot of people who do want this thing. So its acceptability gets amplified once people start thinking 1 and 2 steps ahead. And then that Menger said that process just snowballs. Right. So like in prison, or famously in a POW camp in World War II, even people who don't smoke would be willing to trade away valuable things like, shoelaces or extra rations and stuff for cigarettes, because a lot of people did smoke. And so everybody knew, oh, if you need to get something, having some cigarettes, you're not going to have trouble getting what you want. And so then the flip side of that is whatever it is that you're trying to trade away, as long as you can find somebody who's got cigarettes and wants what you have, go ahead and make that trade, because you're not going to have any trouble unloading those cigarettes. So that's the idea. Again, even though not everybody smoked, everybody was willing in a prison or a POW camp to accept cigarettes. Okay. So then Menger says that process snowballs, and then eventually just one or a few commodities outstrip all the others and become generally accepted in the community. So it's in the beginning, just in terms of the direct use, each commodity might only have 15% of the community wants it, or 20% or whatever. There's a ceiling. But then because of this idea of, people looking 2 steps ahead started expanding what they take, and then that starts snowballing. Eventually, there's one or more commodities, but probably not that many, where just about everybody in the relevant community that you might interact with is willing to accept that particular thing. And so then Menger said, that's what it means to be money. Okay, so notice there how and I'm obviously condensing his explanation here in the interest of time, but that was the basic story he told. So notice he can explain how you start out from a condition of barter and end up with the community, quote, spontaneously adopting something as the money without anybody having to realize the implications of what they were doing, or to be able to tell a story ex post about why it's more efficient for us all to trade against this one thing rather than just relying on barter. So once you have money, there's a lot of advantages that flow from that. In the interest of time, I won't go into that stuff. You can read my book if you want to see it. But using money has a lot of social purpose behind it. Okay, it's not just some arbitrary thing of the capitalist system. Your society is fantastically more economically advanced if everybody's using money versus barter. Okay. Incidentally, just real quickly to circle back about that Graeber claim, just a few points about why I disagree strongly with him. So one thing is, we can see almost in the lab, as it were, the Mengerian story play out. Like I said, there's this famous article called The Economics of a POW Camp. It was some British Royal Air Force economist by training he's in the army, in the Air Force during the war. He gets shot down, is taken into a German POW camp, and all the Red Cross rations coming in, they actually ended up, like on a blackboard, would be quoting various types of goods and how many cigarettes you had to give up in exchange for them. And he even got into it and said, really what we meant was the amount of tobacco in a standard cigarette, right? Because you could cheat, and if it was really just a cigarette, somebody might try to like unroll it a little bit and knock out some of the tobacco or that kind of thing. And so he said what we meant was a full-bodied cigarette. The tobacco in it was really the money, but we just called it a cigarette. Okay, and he goes through, and there was inflation and stuff too, right? When the rations came in, there was an influx of new cigarettes, or some people figured out a way to bribe the guards and let in, new amounts of cigarettes were coming in that way. And then there was inflation in the sense of, the cigarette prices of everything went up as more cigarettes came into circulation, right? So he's an economist sitting here observing all this stuff and then later wrote it up for an economics journal. Okay, so that was clearly the Mengerian story playing out. They started out in a state of barter, and then quickly, for the reasons I went over, cigarettes became the money, all right? The problem with Graeber's story, just an example, I'll link also, by the way, I've written this up when I got his book and went through it. For one thing, his story about, people start out like in communities that aren't capitalistic and based on acquisitive and, dog eat dog, and then we got private property. No, it's more community based, and the tribe looks out for itself. But still there's things about, you help your buddy and then he owes you a favor, and then it kind of just gets. And the problem is, okay, you can say, yeah, I gave you some of my kill when it happened, and then next harvest you might need help, and so you'll return the favor. Wait, I'm getting started. Maybe you gave me some of your kill, and then later down the road when you need help with the harvest, I'll chip in and give you my labor to kind of return the favor. And that's fine. But then the problem is, in order to make that work, to say like, did you return the favor or not? Or did you over repay him? You need to know, well, how much does a portion of his meat right now, how much is that worth in terms of labor time next harvest? Because those aren't commensurable things in terms of their natural units, right? So how are you supposed to know if you repaid the favor if you're not just literally doing the same thing back? Okay. And then even there, is there interest, right? Like if I watch your kids this week in exchange for down the road, you're going to watch my kids. Is it just one for one? I mean, that's a natural assumption, but who says it has to be, right? So anyway, I'm just saying there's elements there where it's not enough just to say, oh yeah, you had these debts that were owed in terms of in kind, And then that kind of just got amalgamated into the money. And then it was originally credit, and then that spawned a monetary system. And then barter only happened when things broke down. No, he skipped a big part of the step. And what's interesting too is, in terms of the anthropological evidence, if you go look at it, Graeber and other people in that vein who like to say that, oh yeah, these modern armchair economists, they want to tell a story about money emerging from barter naturally because they don't like the government. But really, if you go look at the historical records, it's like the religious authorities or the people running the city-states, the political leaders, they just, by fiat, said what the money was. And you can go look and we have records and blah, blah. And the money in those, at least the ones that I looked at in terms of this evidence that they offered, was always like a shekel of silver. I was like, that's kind of a funny coincidence that according to their story, it could have been anything, some abstract unit, just like kind of how Satoshi's in terms of the Bitcoin blockchain, that's not a weight of silver or something, that's just an abstract thing, right? But the story they were telling historically, why should it be a shekel of silver? That would make sense if money emerged through the Mengerian route, right? And by the way, in that Mengerian story, the reason gold and silver were the market's natural candidates for money is because they had a lot of properties that made them ideal for that task, right? That if you're going into market with something that's relatively illiquid or unmarketable, and you're looking for something to take in exchange, actually taking 1,000 eggs isn't a good idea, because eggs you can break and they don't last very long, stuff like that, right? Same thing with cattle. Well, you got to take care of them. They're hard to wrangle. They go to the bathroom. It's hard to make change with cattle, right? If something is 1/10 of a steer, how are you supposed to pay for that and walk away with your 9/10 of a steer remaining change? You see what I'm saying? Whereas precious metals, that works well because they're very homogeneous and so forth. They're stored, durable and so on. Also, too, just real quickly, things like emeralds and rubies and diamonds are valuable, and they have many properties that might make you think they would be good as money, but they're not divisible and homogeneous, right? To say, oh, I got a pound of diamonds, that it matters. Are you talking about like one giant diamond that weighs a pound, or are you talking about 10 diamonds that each weigh 1/10 of a pound? That matters. Whereas with gold, that doesn't matter in terms of just the raw metal, right? Like if you just have a big chunk of gold that weighs a pound, you could also have 10 chunks of gold that are each 1/10 of a pound. You could just melt them down and put them together and create the first thing, right? So whereas with diamonds, you can't just say, oh yeah, take 10 little diamonds and melt them and put them into one big, that doesn't work physically, okay? So I'm saying in the Mengerian story, why gold and silver are excellent monies makes total sense. And so if Graeber's story is correct, and it was all just a matter of political or social power, and people just designating something by fiat or saying, we insist that taxes be paid in this through this mechanism. Why would they pick a shekel of silver? There's no reason to. Okay. So that's just some of the problems with his approach. Now, as far as the modern banking system where loans, in a sense, create money, I think Ludwig von Mises, in his book, that the English translation they gave to it is The Theory of Money and Credit. That was sort of like his doctoral dissertation, 1912. It was also in this book that Mises laid out what we now call Austrian business cycle theory. But in the beginning, he just gives a taxonomy, and he explains that he thinks the way to proceed is to distinguish between what he called money in the narrower sense and money in the broader sense. And so the narrow sense is like the raw base money, the underlying foundation. And then money in the broader sense, in his taxonomy, would include what he called money substitutes. And so that would be things like airtight claims to money that are payable on demand and that normally trade at par. Okay, so in this framework then, if like gold coins are the actual money, and then you go and put 100 gold coins in a checking account at a bank, the bank issues you a deposit slip, and then you're walking around town saying, yes, that bank owes me 100 gold coins. Here's the bank note certifying that this thing is as good as gold, this note that the bank issued. And then merchants might, as long as they trusted that bank and in practice, said, anytime we present that bank's notes for redemption, they give us the gold coins upon demand. So they might start selling stuff to people who just pay with the notes. Okay, so in that world, Mises said, sure, there's a sense in which you can include those notes as part of the money stock if you want. But he was careful to distinguish between money in the narrow sense and the broader sense, partly because his theory of the business cycle relied on that mechanism. And he said what happens in a typical boom-bust cycle in the market economy is the commercial banks extend credit gratuitously, where they just print up more banknotes or just credit people's checking balances in terms on the ledger. And then those people are going around town spending more, interest rates fall, even though the community really hasn't saved more. Out of current production, it's not that more was diverted into saving and less to consumption, or I should say, more was diverted into investment and less into consumption in terms of the physical machinery of production. Okay, and so there's this divergence between like the money economy and the natural physical economy, if you want to talk like that. Okay, and so that's what Mises thought spawned an unsustainable boom that ended up in a crash. Was that the banks, in a sense, were making loans with money that they were creating. So that's fine. And so that in terms of like Richard Werner's framework and Perry Marilling and so forth, you can see where they're coming from. But again, it's in Mises' approach, it's not like you just walk around in a big circle. Ultimately, you can distinguish between what's the actual money versus what is really the promise to pay the actual money, which itself can begin to circulate in many scenarios as if it were just as good as the underlying money. And I did a 3-part blog post series here at the Infineo website. We'll link, of course, in the show notes to it, where I just went through that to try to isolate this important difference. And so I think fundamentally how this comes to a head is, what is a bank run? What happens in a bank run is that the public might say, oh yeah, Bank of America owes me $1,000. And then what happens if there's a run on Bank of America? Its customers go to it and say, you know what? You know how you owe me $1,000? And in our current environment, what that really means is you owe me $1,000 worth of Federal Reserve notes. Well, I'd like to withdraw them, please. That's what you said the deal was. That's why I can go around town buying things by transferring my liabilities with Bank of America to the merchant, is because you tell everybody, whatever you want, you can turn our liabilities into Federal Reserve notes. And that's why we're good for it, and that's why you can trust us. And that is only because of that expectation that the community would accept liabilities with Bank of America as being, quote, the same thing as the underlying actual money. Okay? And so since bank runs are possible, that shows that the community doesn't actually treat liabilities with Bank of America as literally the same thing as Federal Reserve notes. All right. Saying I have $1,000 on deposit with Bank of America is not the same thing actually as saying I have $1,000. All right. And again, it gets nuanced and confusing because monetary aggregates like M1 and M2 and so forth do include checking account balances in those aggregates. And so it is a true statement to say deposits with Bank of America count as part of the money supply. Or, when you say, what's the stockpile of US dollars right now? Depending on which aggregate you're looking at, you could include everybody's balance with Bank of America, checking account balance. But yet, as I'm saying here, just to beat that horse, you see the sense in which, okay, but fundamentally, no. You can unpack that and you say, really, that's only a matter of convenience. And that's only something that's true in general. In a crisis, it's better to have green pieces of paper that say Federal Reserve note on it than it is just to show a white deposit slip from Bank of America saying what your checking account balance is. Okay? And then even with the Federal Reserve, I think the right way to handle that economically is to say since 1971, when Nixon closed the gold window, the underlying base money of the U.S. system is a Federal Reserve liability. That's what the bedrock money is, just a Federal Reserve note, if you want to call it that. Okay? And yet there is something a little bit weird about that, to be sure. But on the other hand, nobody doubts that if the U.S. government wants to keep buying stuff, they're just going to print up money, or the Fed will just, electronically create more deposits with itself, liabilities on itself. Because ultimately, and nothing constrains that except politics, the public's goodwill. They don't want to cause too much price inflation, but nothing constrains them the way Bank of America is constrained, right? You can't have a bank run on the Federal Reserve. That's maybe a way of putting it. If all of the major banks that have reserve accounts with the Fed said, hey, we want notes, green pieces of paper. We don't want to have this electronic reserves with you. The Fed legally can just instruct I think it's the Bureau of Engraving and Printing or something, to just go ahead and crank up the printing press and print it. Whereas again, if there's a run on Citibank might have FDIC insurance and so on, but that's a separate issue. In terms of just legally at the moment, Citibank cannot just say, oh yeah, we got a bunch of liabilities, we can just crank up the printing press. If Citibank tries to do that, that's counterfeiting, that's illegal. They go to jail. Whereas the Federal Reserve, they say, yeah, that's what it means. If Bank of America has $1 billion in its reserve account with us, from Bank of America's point of view, that's legally just as good as if they have $1 billion worth of green pieces of notes in their vaults. It's the same thing. They're both considered reserves of Bank of America, the way our system works right now. Okay, so that's the sense in which, in that 3-part blog series that I'll link to, I encourage you to read it if you haven't. I just go through and show how even a big rich company like Tesla can't, quote, create money. Tesla can loan money to people, but there's a sense in which they had to have the money first before they lend it out. Citibank can create money by making loans to people. That's what Richard Werner is talking about in his appearance on Tucker Carlson. But when you understand Citibank's power of money creation vis-a-vis Tesla, you realize it's not absolute. Because again, there's a sense in which the Federal Reserve can create US dollars in a fundamental way that even Citibank can't. And again, one way of seeing that is to see that you could imagine what a run on Citibank would mean. It doesn't even make sense to say there's a run on the Federal Reserve. What would that even mean? That also underscores why to say the Fed's assets are collateralized is kind of goofy. Incidentally, there is conceivably an important element to that where if price inflation is running too hot and the Fed wants to suck dollars out of the system, if it still has good collateral, like assets that are performing well and so on and haven't had a capital loss since they were purchased, then the Fed can sell those assets off its books and absorb dollars out of the system and destroy them, which it might want to do, again, in terms of like dampening consumer price inflation if it's running too hot. But that's different from saying they need to have collateral to back up their, in case they default on their liabilities. So that's not, because again, to say the Fed has $1 billion in liabilities in terms of outstanding Federal Reserve notes, that's not really, doesn't mean anything. Nobody can do anything with those. They can't come, you could say, here's my $100 Federal Reserve note. What do I get for it? To say, we'll give you 5 20s, 10 10s, 100 singles. What do you want? And that's not, you see how that's just qualitatively not the same as if somebody goes to Bank of America and says, hey, it says here, I got $100 in my checking account with you. I'd like it, please. And then they have to give you 10 10s. That does mean something. Citibank has to have that in the vault. Whereas the Fed can just create it because that's what it means. There's nothing backstopping it. Okay. Oh, and one last thing too, is that all, like as far as Lynn Alden and so forth and the ledger-based money, in Mises' taxonomy, I have argued that Bitcoin, I think, is a fiat money. Okay? Because just when you go through the definitions, I think that's where you'd have to put it. And just showing it, fiat money, even though we associate it with dirty government, coercive money, not necessarily. Like Bitcoin, I don't think you call it a commodity money. Mises also had this category called credit money, which I don't think it is. So I think you'd have to put it there. And yes, it is ledger-based. If Lynn or Jeff Snyder wanted to argue that Bitcoin, by its very nature, is intrinsically tied to a ledger, and so it's ledger-based money, okay, that's fine. But again, I would just say that's a historical circumstance. Like you wouldn't say there was a period of rectangular-based money because a lot of times the money was based, printed on rectangular pieces of paper. Like you would say money is intrinsically based on rectangles. No. Okay, so I still think the original Misesian framework can handle Bitcoin if that should ever become money because it's a generally accepted medium of exchange. It's not there yet, I don't think, but conceivably it could be. So you can handle that. But then the last thing I'll say is, as far as Jeff Snyder's framework, and I think he would argue that like the euro dollar is a system of ledger-based money, showing that, oh yeah, that old thing, like Federal Reserve notes, that's so passé. No, because even there, again, ultimately, yeah, even though people in Germany, like that system might largely rely on banks' claims on each other and so forth, maybe a bunch of smaller German banks, when they settle up with each other, ultimately they're just moving accounts that they have with JP Morgan or something, and maybe that's how they clear things. Still, when you say, well, what does it mean to say JP Morgan owes this German bank $1 million? Ultimately, it's part of that earlier framework I described, that JP Morgan is not, the buck doesn't stop there, no pun intended, when it comes to JP Morgan in US dollar issuance. Okay, there could be a run on JP Morgan. So even there in the euro dollar system, even though in practice, if you go look at the daily transactions and clearings and so forth, it might look like having literal Federal Reserve notes or even balances with the Fed doesn't come into the story very often. Ultimately, that still isn't back in the wings, right? And then again, the way to see that would be in a crisis, watch what happens as people rush to liquidity. Okay, that's a good place to wrap up. Again, I'll put links in the show notes for all these things if you want to read more. Thanks for your attention, everybody. See you next time.